may have noticed, but we've been quite focused on ETFs lately, and today we're taking a look at leveraged ETFs that use. These funds use financial derivatives to double or triple the returns of an index, such as the NASDAQ 100. That's in contrast to a regular ETF, which aims to mimic the long-term performance of the underlying index it tracks. A leveraged ETF looks to reflect the daily returns of an index. Leveraged ETF managers rebalance their holdings every day to ensure the fund stays as close as possible to its stated goal. And what are the goals of leveraged ETFs? Well, as noted, a leveraged ETF looks to double or triple the daily returns of the index it tracks. Some leveraged ETFs, inverse ETFs, want to see 2 or 3 times the inverse of an index daily performance. The possibilities are limitless. However, the utility of leveraged ETFs for everyday investors comes with serious considerations and are not long-term investments. These ETFs have daily, not long-term goals, which is why they rebalance daily, and they're really volatile. Many experienced investors use leveraged ETFs as short-term hedges, and they typically charge much higher fees than normal ETFs, and this is to compensate for the cost of buying the financial derivatives they're using. The bottom line is this. While there might be a place for these instruments in your portfolio or as part of your trading activities, they require advanced knowledge of the overall mechanisms of the market as well as the specifics of leveraged ETFs themselves. We've just scratched the surface here to, more than anything, warn you about common misconceptions and potential dangers associated with leveraged ETFs. Most investors probably have very little need to enter this relatively complicated territory.